They say the market is a casino. They are wrong. A casino is a place of predictable odds where the house always wins because the rules are mathematically sound. The market, however, is a place of human emotion, a chaotic arena where the vast majority of participants consistently fail to grasp the underlying mechanisms. I have watched this cycle repeat for decades, and the root cause of failure is always the same: a profound, almost willful misunderstanding of probability and discipline. I am often asked about the secret to success in this endeavor. People expect a complex formula, a hidden algorithm, or a proprietary data source. They are disappointed when I tell them the truth. The secret is the relentless application of logic, the absolute rejection of emotion, and the mathematical certainty of preparedness. Today, we're going to discuss a concept that seems almost too simple, yet is systematically ignored by the emotional investor: the strategic, unemotional holding of cash. The traditional narrative, the one preached by those who mistake conviction for data, is that cash is a drag, a wasted asset, a sign of timidity. This is a profound error. Cash, when viewed through the lens of a quantitative mind, is not a position. It is a mathematical option. It is the ultimate expression of optionality, a non-correlated asset that grants you the power to act when others are paralyzed by fear. The title of this discussion is direct: Always hold cash to prepare for crashes. Cash is king. But let us be clear. This is not a piece of market timing advice. I do not believe in market timing. I believe in systemic preparedness. The emotional investor sees a market crash as a disaster. The quantitative mind sees it as a massive temporary mispricing event, a sudden violent shift in the probability distribution that creates an opportunity for asymmetric returns. Without a pre-positioned, non-emotional reserve of capital, that opportunity is mathematically inaccessible. You are merely an observer, a victim of the very volatility you should be exploiting. The failure of the traditional approach is rooted in 3 fatal mistakes, all of which are psychological, not financial. The first mistake is the pervasive belief that every dollar must be constantly working. This is the cult of 100% allocation. It is a psychological compulsion driven by the fear of missing out, the infamous FOMO, and the desire to maximize every basis point of return in a bull market. The emotional investor views a 3% cash position as a 3% loss of potential upside. The quant views it as a hedge against the unknown unknowns, a necessary friction that lubricates the entire system. Let us consider the mathematics of this. If you are 100% invested, your system is brittle. It has 0 degrees of freedom. When a systemic shock occurs, a black swan event, a sudden policy change, or a geopolitical crisis, your only recourse is to sell into the panic, locking in losses, or to ride the decline, hoping for a recovery. Both are emotional responses. The 100% allocation strategy is a statement of absolute certainty in the present, a certainty that the history of markets has repeatedly proven to be a delusion. My experience in mathematics taught me that a system must have robustness. Robustness is not about maximizing the average case. It is about minimizing the damage in the tail events. A small strategic cash reserve, say 5% to 10%, is the mathematical equivalent of a circuit breaker. It is a non-linear tool. In a normal market, its cost is negligible. In a crisis, its value approaches infinity because it is the only thing that allows you to execute a buy order when the market is offering assets at a 50% discount. The emotional cost of holding cash is a few percentage points of potential return. The cost of not holding cash is the inability to participate in the greatest wealth transfer events of a generation. The choice is mathematically trivial. The second mistake is the conflation of liquidity with opportunity cost. The emotional investor sees cash earning 0, 5% in a money market account, and laments the loss, 10% they could have made, in the S&P 500. This is a fundamental miscalculation of risk-adjusted return. Liquidity is a form of insurance. You pay a small premium, the difference between the cash return and the market return, for the certainty of immediate access to capital. The value of this insurance is not constant. It is a function of market volatility. When volatility is low, the insurance seems expensive. When volatility spikes, the insurance becomes priceless. Think of it as a complex option contract. You are holding a perpetual zero-strike call option on every asset in the market with an expiration date that is always tomorrow. The strategic, unemotional holding of cash is not a position, but a mathematical option and the ultimate expression of optionality. It is a non-correlated asset that grants the power to act when others are paralyzed. For the quantitative investor, a market crash is not a disaster, but a massive temporary mispricing event, an opportunity for asymmetric returns that are inaccessible without a pre-positioned cash reserve. Traditional failure is rooted in three psychological mistakes. The cult of 100% allocation, FOMO. The belief that every dollar must be constantly working. The error, a 100% invested system is brittle and has 0 degrees of freedom. It forces the investor to sell into panic or ride the decline. The quant view, a small strategic cash reserve, e.g. 5% to 10%, is the mathematical equivalent of a circuit breaker and a non-linear tool. Its cost is negligible in normal markets, but its value approaches infinity in a crisis, because it enables buying assets at a significant discount. Robustness prioritizes minimizing damage in tail events over maximizing the average case. Conflation of liquidity with opportunity cost, lamenting the low yield on cash while ignoring potential market gains. The error, miscalculating, risk-adjusted return. Liquidity is a form of insurance. The quant view, cash is a perpetual zero-strike call option on every asset, where the low yield is the premium. The payoff is the ability to purchase assets at statistically improbable prices. A sound liquidity model is essential to survive non-linear cascading effects of fear, e.g., 2008, emotional attachment to the status quo, extrapolating the present into the future, psychological inertia. The error, comfort in the crowd and confirmation of existing bias. The quant view demands a constant, cold-blooded assessment of the system state, independent of recent performance. Holding cash is a declaration of preparedness for a change in the statistical regime and a rational hedge against euphoria. Cash is the uncommitted computational power that fuels a pivot based on new data. 4 core lessons for a disciplined cash framework. Cash must be a quantifiable variable. The cash amount must be an algorithmic function of system volatility and statistical probability, not a vague feeling. Calculation, the cash position, C dollars, is determined by 2 components, C, non-text, drawdown safety, plus untext, opportunity capital. The drawdown safety component covers the maximum expected drawdown plus a safety margin, e.g. 2.5x the maximum calculated stress, like an engineer's safety factor on a bridge. The opportunity capital component is the amount needed to deploy to take advantage of a statistically significant event, e.g. a 3 sigma market mispricing. Decision. The decision to adjust cash levels is algorithmic, triggered by a change in the statistical environment. The system must plan for an L-shaped stagnation, not a hopeful V-shaped recovery. Cash is the perfectly non-correlated hedge. When asset classes correlate toward one and fall together, diversification fails. The principle: true diversification is holding assets that behave differently under stress. Cash is guaranteed to maintain its nominal value, acting as a psychological anchor against panic-driven decisions. Tail risk, mitigation. Cash is the only asset that provides a guaranteed offset to the non-Gaussian tail risk, extreme high-impact events that occur more frequently than standard models predict. It acts as the strategic reserve force in a military campaign, ensuring the survival of the capital structure. Preparation and deployment are algorithmic. Holding cash is preparation. Deploying it is execution, the final barrier between amateur and professional. The discipline. The quant does not wait for the statistically meaningless bottom, but for the statistical signal, a deviation from the mean exceeding a predefined threshold. Deployment strategy. The decision is made in advance, and the reserve is deployed in tranches according to a preset, emotion-proof schedule, e.g., 25% at a 20% correction, 35% at a 30% correction, etc. This strategy of mathematical averaging removes the need to predict the exact low point. Systemic equilibrium. Immediately after EFG deployment, the system must begin rebuilding the cash reserve by systematically harvesting a portion of the gains from newly purchased assets, ensuring the system is always robust. Cash is the antidote to the leverage trap. Leverage in the hands of the emotional investor is a catastrophic multiplier of risk. The trap. Leverage erodes the safety factor and makes a manageable drawdown, a forced liquidation, a mathematical ultimatum of the margin call. The defense. Cash is the unleveraged buffer and ultimate deleveraging tool, a reserve sufficient to cover several times the maximum possible margin requirement effectively immunizes the system against the panic of forced selling. Cash buys the time and space needed for models to work and for logic to prevail over market madness. The quantitative investor is a creature of probability and discipline, using the strategic holding of cash as the mechanism to exploit the irrationality of the emotional crowd. Cash is the asset that guarantees your survival.